Have you ever wondered where to invest your $1,000? Let's talk about the art of investing, the crucial role it plays in growing your wealth, and the importance of making the right choice. This is especially vital when you're starting with a sum like $1,000. Our aim here is to guide you, shedding light on the best places to put your money to work. So, buckle up as we delve into the world of finance and investments. First things first, what does investing entail? Well, at the heart of investing lies the concept of risk and reward. This is the fundamental principle that the potential return on an investment increases with the level of risk taken. In simpler terms, the more risk you're willing to take, the more money you could potentially make. Or lose. Consider this: if you stash your money under your mattress, there's virtually no risk, but also no reward. On the other hand, if you invest in a startup company, the risk is high, but the potential rewards could be astronomical if the company takes off. Different investment options inherently have varying levels of risk and potential returns. From the relatively low-risk, low-return world of treasury bonds to the high-risk, high-return potential of the stock market, understanding these dynamics is key to making informed investment decisions. Remember, higher potential rewards often come with higher risks. One popular choice is the stock market. Now let's unravel this a bit. Imagine walking into a bustling marketplace, but instead of fruits or vegetables, people are buying and selling pieces of companies. That's the stock market for you. When you invest in stocks, you're essentially buying a tiny slice of a company. If the company does well, the value of your stock goes up. If it doesn't, well, the value goes down. You can make money in two ways: through the increase in the price of the stock, known as capital appreciation, or through dividends, a portion of the company's profits shared with stockholders. Now, this might sound like a golden ticket, but hold on a second. The stock market is like a roller coaster ride. It has its ups and downs. It's volatile, meaning prices can change rapidly in very short time periods, which can lead to significant financial loss. But here's the catch. With higher risk comes the potential for higher returns. It's also worth noting that you're not just buying a stock, you're buying into a company. You're putting your trust in that company's management, its strategy, and its success. You become a part owner of that company, and your fortunes rise and fall with it. Before you jump in, do your homework. Research the company, understand its business model, and assess its financial health. Stocks can provide high returns, but they're also subject to market volatility. Another option you might consider is real estate investment. This is where you purchase property with the intention of making a profit. You could buy a house to rent out, for example, or you could invest in commercial real estate like office buildings or shopping centers. But what if you only have $1,000 to invest? Well, that's where real estate investment trusts, or REITs, come into play. REITs are companies that own, operate, or finance income-generating real estate. They work a bit like mutual funds for property. You buy shares in a REIT and they use your money to invest in real estate. This gives you the chance to get involved in property investment without needing to buy a whole building yourself. The potential returns from real estate can be substantial. Rent payments can provide a steady income, and properties often appreciate in value over time. Plus, with REITs, you can often get dividends from the profits the trust makes. However, like all investments, real estate comes with risks. Property values can go down as well as up. Renting out property also requires management and maintenance, which can be time-consuming and expensive. And REITs, while offering a lower entry point, still come with the risk of market volatility and potential loss of investment. Real estate can be a stable investment, but it also requires more management and has its own set of risks. Bonds and mutual funds are other options to consider, but what are they exactly? Let's break it down. Bonds are essentially loans you give to corporations or the government. In return, they agree to pay you back the principal amount along with interest over a set period. This makes bonds a relatively safe bet since you're guaranteed a return unless the issuer goes bankrupt. However, the trade-off is that the returns are often modest compared to other investment options. Now let's shift gears and talk about mutual funds. These are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. The beauty of mutual funds is that they allow you to own a piece of many different investments, spreading out your risk. You're not putting all your eggs in one basket, so to speak, but remember, every investment comes with its own set of risks. With bonds, there's the risk that the issuer could default. And with mutual funds, while diversification reduces risk, it doesn't eliminate it. The value of mutual funds can fluctuate based on the performance of the underlying assets. Bonds and mutual funds can offer steady returns with less risk than stocks, but the potential for high returns is also lower. It all comes down to your personal risk tolerance and financial goals. A balanced portfolio often includes a mix of stocks, bonds, and mutual funds to spread out risk and potential returns. So where should you invest your $1,000? A vital question, and the answer lies in a strategy known as diversification. Diversification, in simple terms, is the practice of spreading your investment across various types of assets. This could include stocks, bonds, real estate, and mutual funds. Now, why would you want to do that? Well, the primary reason is to limit risk. Consider this: if all your eggs are in one basket and that basket falls, you lose everything. But if you've distributed your eggs into several baskets, the loss from one won't be as devastating. In the world of investment, these baskets are different types of assets. Each asset class behaves differently under various market conditions, and this difference in behavior is what makes diversification such a powerful tool. For instance, when the stock market is performing well, your stocks might see substantial growth. However, if the market takes a downturn, your stocks might lose value. But your bonds could remain stable or even increase, offsetting the potential losses from your stocks. Similarly, real estate can provide a steady stream of income through rent, while mutual funds allow you to invest in a diversified portfolio with a single transaction. By spreading your $1,000 across these different types of investments, you can minimize risk and increase your potential returns. So, how should you diversify your $1,000? There's no one-size-fits-all answer. It depends on various factors like your financial goals, risk tolerance, and investment horizon. You might decide to put a certain percentage into stocks, another into bonds, and the rest into real estate and mutual funds. Or you might choose a different mix that suits your unique circumstances. Investing your $1,000 wisely involves understanding your risk tolerance, exploring different investment options, and diversifying your portfolio. Remember, every investment comes with its own set of risks and rewards. Happy investing.